Good morning, folks. I'm not sure exactly what time it is in your local area, but I'm in Spain right now. And in Spain, it's a good morning right now. So, good morning, folks. And I just woke up like, I don't know, 10 minutes ago. So, I might let some things slip, which I wouldn't otherwise. So, good for you. Anyway, at the end of the vote, ES won. All right. So although I must admit Euro was a lot more interesting, we're going to have to go with ES. The people have spoken, and their word is going to be allowed this time. Because usually it's a dictatorship. There's no democracy in the group. Excuse me. Anyway, so we start now. Now, as we have been taught, the best way to analyze a chart is not to open the chart and go to the 5 minute, 1 minute, and just look for a market structure shift. Because that's what they do on Twitter, but that's not the ideal way of doing it. All right? The ideal way is as follows. So you open a chart, you want to enter a trade. For the most, for the highest probability trade to form, you must go through this process, which is number one, you see the seasonality. Number two, you check the monthly bias. Before I continue, I know some of you personally who are in here who are not that proficient, and in that case, go study. Go study and come back and listen later, because I'm assuming that the vast majority of you who are listening are at least semi-proficient with the concepts. So when I speak, it's not going to be like I'm speaking to you in gibberish or some other language. Okay? So, back to the sequence, which is first the seasonality. Number two is going to be the monthly bias. Number three, the weekly profile. Number four, the daily bias. Number five, the time of day within the daily bias. So now we have that aside. Now we apply this on ES, which won your vote. I know some of you are disappointed in the result, but it is what it is. Maybe I'll review the EU later if I get enough requests. So we look at ES. What do you see? Now the fun thing is we're going to ignore all these candles. Most of these candles, they don't matter to us. We're looking at a 20, 40, and 60-day look back. Okay, so that's going to be around 8 weekly candles. So we go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. All right? And then within that time period, we mark out the PD arrays. Now, before I mark the PD arrays, there's something more important than the PD arrays, which is liquidity. In this instance, we have had a purge in liquidity right here. You see this? So smart money accumulated their shorts up here, and now they're violently taking it back down and distributing it in the opposing direction, because that's what they do. So we have had a purge, and we are now in a cycle of purge and revert. All right? You got the purge, you got the failure swing, and then you got the continuation lower. Now, the end goal of this purge and revert cycle we're in right now is this original consolidation, in my eyes. So for me, the bias for ES is down until we take this out. So that for me has it gets the magnet emoji or the eye emoji. Get this color, a little bit more precise. And then we go and give it the eye. Eye. So we have had a purge on liquidity where smart money has accumulated their shorts up here clearly because some people went long up there. We saw them on Twitter. We saw my harmonic friend, which I sent as a warning at the top. It's always see there's a lot more losing traders than winning traders. So it's there's always some indicator at tops and bottoms, which I like to take guidance from, take a signal from. So all that aside, we have had a purge on liquidity, and now we are distributing. They are distributing that liquidity to the downside. Because for every buyer, there has to be a seller, and vice versa. It's not just price randomly moving around. So we go back to the weekly chart. We have had a purge on liquidity, with the draw on liquidity being number one, the rejection block, which has been reached. All right. And it gave us a reaction. So one target has been met of this purge. All right. Which is the body of the candle. The next target is the wick of the original consolidation. And as we know, at each target, we expect a reaction, potentially a reversal if we have SMT. So keep that in mind. But again, the distribution and accumulation is done between highs and lows. So they take orders from highs and lows, and they distribute them to highs and lows. So after the purge, we were given a PD array, which is this order block. As soon as this candle closed below it, we have as one order block right here. All right. And then that order block gave us another order block, which is a propulsion block right here. All right. So we have time, which is the data ranges. We have a liquidity purge. We are in a distribution cycle right now. And we have these two PD arrays to key off of. I think that's clear enough. Sadly, you cannot communicate to me your questions in this one because it's recorded, but maybe in the live stream next time. So, and that's also a breaker, by the way, right there. So we have two PD arrays overlapping. So we remove this noise because I don't like my charts to be dirty. And we go down to the weekly profile. We mark the opening of the week at Sunday. And we mark the closing price, or the closing time, rather, of the week, which is Friday. All right? Now, this specific trade was taken at the end of the week on a Friday. So we're going to ignore all of this for the moment, and we're going to focus on the end of the week, which is Friday. So we we mark the midnight price of Friday. And this is the section of the week. We're going to ignore all of this. We're going to consider it to be noise, except this high right here. And we're going to focus in on this subsection of time we have here. All right? And yeah, that's it. There's no and. Now, the best chart, in my eyes, to look at the weekly profile is the best time frame, is the 2-hour time frame. All right? And the best time frame to look at the daily profile is the 15-minute chart. You can also use the 5-minute, but I prefer the 15 because anything below the 15 is noise. So my preferred time frame of for looking at a weekly profile is going to be the 15 always. And I just said weekly, and I'm in daily, but we're just going to act like nothing happened. So this is Friday. Of course, none of this had happened. All right? So we're going to look at it and imagine that this is all invisible. We only I just now noticed that they offer the volume of the candles within this movement, which is cool. Anyway, that's off topic. We're going to ignore that any of this happened. All right? And we're going to focus on the opening time and the closing time of the candle. So, before we go into this day, we look at the previous day's high time frame PD arrays. We have this BISI, or discount fair value gap right here. All right? So that's one area to look at as a target. And we have the previous day's high. Over here, which is still pending. So go to the 15-minute chart. Now, whenever we see the previous day being extended already, all right, you got to focus on this one. So we are now on Thursday and Friday, which we know cap the weekly range. So it's unreasonable to expect a continuation of the range, except if we did not reach the average weekly range, which we did, I believe. But it's not reasonable to expect an extension of the range. It's more reasonable to expect a reversal, at least to mark the weekly high. Because as we know, Monday, Tuesday, Wednesday will mark the low of the week, and Thursday, Friday will usually mark the opposing end of the range of the week. All right? Weekly profiles, month 7, if I'm not mistaken. If it's wrong, I'm not gonna edit or delete, because who cares? But it's month 7, that's for sure. So we have the previous day's high right here. All right, we draw the kill zones, the so-called ICT kill zones. We go from 1 to 5. That's London kill zone. We go from 8:15 to 12. That's the New York kill zone. And we go from 1 to 4. That is the PM session, in the classic colors I use on my Twitter all the time. So we have the opening time. All right. And it's a Friday, so you focus on what time is it. time, which is time of day, day of week, week of month, month of year. So now we are at the end of the week, which is Friday. We're expecting the opposing range of the week to form and give us a reversal. All right, that's a reasonable expectation. So, and the previous day was already extended to the upside. So when we see this and we see a rally from the opening price into a higher time frame PD array, which is for you to find and me to know. So we rally after the opening price. During London and at the end of London session, we get a bearish order block. All right. Now, as soon as you get a bearish order block on a 15-minute time frame at the end of London session, then it's reasonable to expect that the high of the day, at least until New York is in. All right. So that's why I sold right here. I'm gonna post the receipts, because that's what people like, after this recording in the group chat, but I'll resend it. So with the Friday review, but I'll send it again. I don't mind. So the point is, end of London, bearish order block at 4:30. So we expect the high of the day to be in. We decline rapidly. So anything above the opening price was premium. We decline rapidly, and then we witness the classic New York OTE, and this is the idea by which I sold. All right, so now we go down into the even lower time frames, which is the 3-minute time frame, the one I used. So it looks like a turtle soup. Oh, it's just a turtle. No, it was a classic sell day on a Friday, expecting the opposing range of the week to form. So reversal at the weekly range. All right. And then this is as you can see, we have expansion, consolidation, protraction, reversal, and then expansion again. That's the idea. So you have to look at everything that happened before New York. You have to mark the daily range and look at it holistically. So I forgot to mention that after this decline we had produced an hourly fair value gap right here, and a breaker. So we have the famous unicorn model. I don't like those names. I like to have a simplistic, basic, bare bones approach. None of that nonsense. Doesn't resonate with me. So, as we can see, we go to the 3-minute time frame. All right. The time is New York kill zone. And we have right here the breaker, which is the black line, and we have the gap, which is the gray line. Now we know that breakers stop gaps from filling in, right? So when you see this, you assume the top is in. But then again, you go back to the rule of the 3 different types of reactions at a key level, and it is safe to assume that you will expect a second touch of the breaker, because that's the most common reaction. So now finally, we go to the 1 minute after already seeing focus and see when we use it. We see the 1 minute after already seeing the weekly, the daily, and the monthly. All right. And now after all that, then we go to the 1 minute. So it's not the main time frame. So this is the breaker reaction, pretty strong reaction. This is a fake market structure shift. This is it right here. A lot of people were suckered down there to sell. I saw a bunch of people too on Twitter. They were like, they sold over here, like right here. They sold at this rectangle, and they held it over here, and they held it over here. And then when it rallies down here, they're like, "Hey, oh, I gotta sell." That's bullshit. You have to hold a standard. You have to hold yourself to a standard. You can't just, you can't be happy with that performance. You can't be happy with entering here and then getting turtle souped, and then me entering here, and then when it finally, after you're sweating your sweat out, I'm not gonna swear. So you held this, you shorted here. You were sweating when it came back here. Oh, finally again, and then you sweated again when it came up here, and then finally, after two emotional roller coasters, finally you get the profits. Is that really what you want for yourself? And this is to the people who, this subsection of the video is to the people who are celebrating subpar performance. Is that really what you want to do? Is to go and sell and then watch it go up and then worry and then, or do you want to enter at the turtle soup itself, which is what I do all the time, every day, every week. So, fake market structure shift right here. Then this is the real Judas. This move happens a lot, which is a key level, maybe a touch, a slight touch, or maybe even not a touch. We have this fake market structure shift, a double top also. Back in my retail days, I would definitely be selling this short down here and getting wrecked, and then watching it come back down. Good old days. So, so finally we get the second touch of the key level, and we get a dig into the 1 hour fair value gap, right? And this is where I went short. Let's remove this noise. We focus only on the main PD arrays right now. The 1 hour fair value gap. So this is turtle soup right here. The turtles have been souped right there. Beautiful. My entry was based on the 3 minutes, of course, as you saw, the infamous, famous rather, not infamous. Infamous means bad. The drawing was based on this, so I had this 1 hour fair value gap pending to be purged. So when I saw this fake market structure shift, I knew someone had been suckered in. All right, someone accumulated longs over here, and they need to distribute the longs above this high into the gap. So that's when this idea came to mind. Right there. Looks good in hindsight, but it's all there in foresight. The proof is in the pudding. That was the idea. Now, some of you are going to ask, how don't you know it's going to keep going higher, blah, blah, blah. I just know, because I have Enigma. Well, not really, that's a joke. The reason I know it's not going to go higher, all jokes aside, is because of this intermediate term high. A lot of you watched that episode and were like, oh, this is too complicated. What is this? What is this complication that ICT, blah, blah, blah. It's to each his own, but I use intermediate term highs as stop losses and as a mechanism to probe whether price is bullish or bearish. So if an intermediate term high is being held, then we're bearish, and vice versa. All right? So this would have been a stop loss, by the way, a very valid stop loss. But I like to play it safe, especially when dealing with large amounts of capital. So my stop loss was the high of the fair value gap right here. All right. So that was the idea. That was exactly the idea. And it was actually a bit higher, by the way. So I was being super conservative. If I had given this out to someone else, I would also be conservative. But this is a valid stop loss. This is a valid stop loss. So that gives you what? Let's take out the infamous risk to reward position. So this would have been a 4 risk to reward. It could have also been easily an 8 risk to reward, and that would be super valid. But the safe play, which I did, was this. All right. But that's where the famous, that's where the idea came from. That's where this arrow was born from. And kept declining into 12 p.m. And then at 12 p.m. it marked the low of the day. This is like classic. This is an example of a classic sell day, like a super classic sell day. Beautiful, absolutely gorgeous. So opening price rallying above opening price, decline, expansion, consolidation, protraction, which is a New York OTE as well, into the 1 hour fair value gap, which is a higher time frame PDRA, and then it expands lower. All right. So that was the idea. That was easy and quick and easier and simpler than the EU one. Maybe if EU, we'll see. Maybe this week, next weekend, we will review the EU trade which I took. Or if there's other trades that present themselves, we can also look at them every day, every week, well, every hour, every 4 hours, and it won't stop. And on that note, I wish you all good luck and good trading. And see ya.